Hello everyone, and welcome to the very first episode of Janice Talks. I'm your host, Janice, and I'm absolutely thrilled to finally be launching this show. This is something I've been wanting to do for a while, and I'm so excited to share this journey with all of you. Here on Janice Talks, we're going to dive deep into the world of business. Each week, I'll be breaking down the biggest news stories, analyzing the latest earnings reports, and making sense of the calls that shape the markets. If it happened in the business world over the past week, and if it's worth knowing, you'll hear about it here. And wow, what a week to kick things off. It feels like perfect timing as we're right in the thick of earnings season. Speaking of which, that brings us to the main event for today's debut episode, Tesla. The electric vehicle giant reported its Q1 2025 earnings recently, and let's just say the results sent some sparks flying, though maybe not the kind investors initially hoped for. On the surface, it looked rough, missed revenue targets, earnings per share well below expectations, and a significant drop in car deliveries. But dig a little deeper, and you find a fascinating story of planned disruption, explosive growth in an unexpected corner of the business, and a company navigating not just serious geopolitical headwinds like tariffs, but also grappling with brand perception issues tied to its high-profile CEO. So, buckle up. Today, we're dissecting Tesla's Q1 performance, figuring out why the core auto business stalled, celebrating the surprising surge in Tesla energy, untangling the complex web of tariffs, and touching on the brand challenges and management's response. Let's get to it. All right, let's start with the headline numbers because they certainly grabbed attention. For the first quarter of 2025, Tesla reported total revenue of $19.3 billion. Now that sounds like a lot of money, and it is, but it represents a 9% drop compared to the same quarter last year. More importantly, it fell significantly short of Wall Street's expectations, which were hovering around the $21.3 billion mark. That's a miss of roughly $2 billion. The bottom line looked even tougher. Non-GAAP earnings per share, the number analysts focus on, came in at just 27 cents. The consensus forecast was closer to 41 to 44 cents per share. That's a substantial miss. Some analysts called it an earnings surprise of nearly negative 40%. And the core of Tesla's business, the automotive segment, really felt the pressure. Automotive revenue plummeted 20% year over year to about $14 billion. Vehicle deliveries, which were already new, were down before the earnings call, fell 13% compared to last year, landing at roughly 337,000 cars. Profitability took a major hit too. The company's overall GAAP gross margin held steady sequentially at 16.3%, but that was down over a full percentage point from last year. More dramatically, GAAP operating income crashed 66% year over year to just $399 million, leading to a razor-thin operating margin of only 2.1%. That's down sharply from 5.5% a year ago. So the big picture? A tough quarter financially, missing expectations across the board, driven by a significant slowdown in the main automotive business. Okay, so the numbers weren't great. The immediate question is, why? What drove the significant underperformance, especially after expectations had already been lowered following the weak delivery numbers announced earlier in April? Well, according to Tesla's management on the earnings call yesterday, the primary culprit was a massive planned operational undertaking, a global changeover for an updated version of the Model Y. CEO Elon Musk and CFO Vaibhav Taneja explained that Tesla decided to transition production lines for the Model Y. Remember, this is the world's best-selling vehicle across all 4 of its global factories simultaneously during Q1. Why Q1? Musk stated they strategically chose the first quarter because it's typically the weakest quarter for car sales. The downside? This simultaneous changeover meant, as Taneja put it, several weeks of lost production during the quarter. This directly led to a lack of new Model Y availability in most markets until the very end of the quarter, hitting delivery volumes hard. Management is framing this as a necessary short-term pain for the long-term gain of upgrading their most popular vehicle globally. They did emphasize that the production ramp after the changeover is proceeding quickly, even outpacing historical ramps. But the Model Y transition wasn't the only factor. Persistent pricing pressure also played a significant role. The average selling price, or ASP, for Tesla vehicles declined year over year. This was partly due to the mix of vehicles sold, but also because Tesla had to offer incentives, especially to clear out inventory of the older Model Y before the updated version arrived. Even though the new Model Y might carry a slightly higher price, the discounts on the older model effectively canceled that out, squeezing margins. The fact that automotive revenue fell 20% while deliveries only fell 13% clearly shows that average selling price drop. Compounding the pressure on profits was a rise in operating expenses, specifically a 22% year-over-year jump in research and development spending. Management was very clear about this. They are consciously investing heavily in the future. This includes pouring money into AI development. Think full self-driving compute power and training, the Optimus humanoid robot program, and development for upcoming vehicles like the Cybertruck, Semi, and those much anticipated lower-cost models, potentially including the Cybercab. This increased spending, even as profits fell, signals a clear strategic choice to prioritize long-term innovation over maximizing Q1 earnings. Management also acknowledged some external factors. There was a negative foreign exchange impact of about $300 million. And then there's a Musk factor. Executives mentioned negative impacts from vandalism and unwarranted hostility towards the brand in certain markets affecting sales. While they didn't dwell on it during the call when asked about brand damage, pointing instead to the Model Y changeover and macro conditions, external reports and online chatter certainly suggest that controversy surrounding CEO Elon Musk's leadership and external activities, including his involvement with DOGE, have potentially alienated some customers and impacted brand perception. This adds another level of complexity to Tesla's demand picture. One final point on profitability: regulatory credits. Tesla generated $595 million from selling these credits in Q1. That's up significantly from Q1 last year and provided a crucial cushion to the bottom line. In fact, some analysts noted that without these high-margin credits, Tesla's operating income might have actually been negative for the quarter. It highlights the ongoing importance of these credits, especially when the core business faces headwinds. So, to recap the why, a major planned Model Y production halt was the biggest factor, combined with lower selling prices, increased R&D spending on future tech, some external pressures including potential brand headwinds, partially offset by a boost from regulatory credits. Now, amidst all the gloom surrounding the automotive segment, there was one area of Tesla's business that absolutely shined in Q1: Tesla Energy. This division, which handles solar generation and battery storage products like the Powerwall for homes and the Megapack for utility-scale projects, had a stellar quarter. Energy revenue surged an impressive 67% year over year, hitting $2.73 billion. What fueled this? Explosive growth in energy storage deployments. Tesla deployed a record 10.4 gigawatt hours of battery storage in Q1. That's a massive 154% increase compared to the 4.1 gigawatt hours deployed in the same quarter last year. They even hit a record for Powerwall deployments, exceeding 1 gigawatt hour in a single quarter for the first time. And it wasn't just about volume. Profitability in the energy segment also saw remarkable improvement. The division achieved record gross profit, and its gross margin expanded significantly to nearly 29%. That's up substantially from around 25% in both the previous quarter and the year-ago quarter. This suggests Tesla is successfully scaling production, managing costs effectively, or perhaps gaining better pricing power for its storage solutions, a stark contrast to the margin pressures seen in the automotive business. Operationally, things are moving too. The mega factory in Shanghai, dedicated to producing the large megapack batteries, produced over 100 units in Q1, which are now heading to customers. Management is clearly bullish on this part of the business. Elon Musk spoke about stationary energy storage eventually scaling to terawatts per year. Both the shareholder letter and CFO Taneja highlighted the growing need for energy storage to stabilize electrical grids, especially with the anticipated surge in power demand from AI data centers. This potential synergy, the AI boom needing more power and Tesla providing the storage to manage it, could be a massive tailwind for Tesla Energy. So while the car business hit a speed bump, the energy division stepped on the accelerator, providing a crucial element of growth and diversification for the company. Okay, we've talked about the struggles in automotive and the success in energy. But hanging over both, and particularly threatening that energy growth story, is the increasingly complex and costly issue of global tariffs, especially those enacted in 2025. The trade environment, particularly between the US and China, got significantly tougher this year. Reports indicate the potential for extremely high tariffs on Chinese goods, possibly exceeding 100% or even 150% for specific categories like lithium-ion batteries. Some sources cited specific combined rates effective April 2025, 173% for EV lithium-ion batteries and 156% for non-EV lithium-ion batteries imported from China. These tariffs hit components critical to Tesla, including batteries, especially the lithium iron phosphate or LFP type, solar components, EV parts, steel, and aluminum. China has retaliated, and the EU also has its own tariffs in play. It's a volatile situation, creating significant cost uncertainty. Now, why is this a bigger problem for Tesla Energy? Management was explicit about this on the call and in their letter. Tariffs are expected to have a relatively larger impact on the energy business compared to automotive. The key reason? Tesla Energy heavily relies on those LFP battery cells for its Powerwall and Megapack products, and a large portion of these cells are sourced from Chinese suppliers like CATL. Think about it. If tariffs are potentially adding 150% or more to the cost of these core components, that directly inflates the cost of goods sold for Tesla's energy storage products sold in the US. Analysts are already seeing the impact, with the landed cost for lithium battery cells reportedly jumping over 30% by mid-2025. This threatens the competitiveness and affordability of Powerwalls and Megapacks in the US, potentially slowing down that impressive growth we just discussed. It also creates supply chain headaches. While Tesla and others are working to build LFP supply chains outside China, potentially in the US, Southeast Asia, or Korea, this takes time, likely years, and these alternatives are expected to be more expensive initially. Plus, the tariffs themselves make it more expensive to import the capital equipment needed to build domestic battery factories. Even the Optimus robot production is reportedly affected by tariffs on Chinese components. So, what's Tesla doing about it? Management acknowledged the risk. They emphasized their localization efforts, claiming high compliance with North American content rules, 85% USMCA for US-built cars, and 95% localization in China for that market, suggesting they might be less affected than some competitors. However, they did concede the bigger hit to the energy business due to LFP sourcing. CFO Taneja mentioned they are commissioning equipment for local LFP cell manufacturing in the US, but admitted this will initially cover only a fraction of their needs. They're also actively seeking non-Chinese suppliers, but again, that takes time. The Shanghai megafactory is intended to serve markets outside the US, which could shield some volume. While Musk generally advocates for lower tariffs, he acknowledged the decision is ultimately up to the US president. They did quantify one specific automotive impact: upcoming Section 232 auto tariffs, expected in May 2025 and covering imports even from Mexico and Canada, are estimated to hit profitability by about $2,000 per affected vehicle. The bottom line on tariffs: they represent a major material risk, especially for the fast-growing energy segment's cost structure and near-term growth in the U.S. Mitigation is underway, but it won't be instantaneous. So we have a picture of a company facing significant near-term challenges in its main business, offset by strong growth in energy, but with that growth now facing serious tariff headwinds and potential brand perception issues swirling around. How did Tesla frame this, and what's the outlook? Unsurprisingly, management spent a lot of time on the earnings call shifting the focus from the disappointing Q1 numbers towards future potential. Elon Musk reiterated his view that Tesla's future is fundamentally tied to large-scale autonomy and humanoid robots, even stating he believes Tesla, with excellent execution, will be the most valuable company in the world. They pointed to several upcoming catalysts: the successful production ramp of the updated Model Y, which they claim is outpacing past ramps, the planned launch of more affordable vehicle models still slated for the first half of 2025, the imminent launch of their Robotaxi service starting in Austin this June, continued progress in full self-driving capabilities, including its recent introduction in China, scaling up production of the Optimus robot, with Musk targeting thousands working in Tesla factories this year and potentially millions per year within 5 to 6 years. And of course, the continued massive growth potential of the energy business. These ambitious long-term bets are the justification for that heavy R&D spending we discussed earlier. And addressing those concerns about CEO focus, Musk made a point during the call to confirm that the time he spends on DOGE, that external activity drawing controversy, will drop significantly starting in May. This seemed aimed at reassuring investors who wanted to see him recommit fully to Tesla, perhaps seeing it as a step in the right direction. Interestingly, despite the significant earnings and revenue miss, Tesla's stock price actually rose quite sharply in after-hours trading following the call. This suggests investors were perhaps relieved the results weren't even worse, or more likely, they bought into management's narrative focusing on future growth catalysts like Robotaxi, Optimus, and cheaper models, rather than dwelling on the messy Q1 numbers or the brand concerns. So wrapping up our deep dive into Tesla's Q1 2025 earnings, what are the key takeaways? What should we be thinking about? First, was this quarter just a necessary temporary dip caused by the planned Model Y transition, suggesting a rebound is likely? Or does it signal deeper issues in the automotive business related to demand, competition, pricing power, and maybe even brand perception that might linger? Management clearly pushed the planned transition narrative, but the underlying pressures are real. Second, the energy segment is undeniably a powerful growth engine with impressive margins. But can it maintain this trajectory, especially in the crucial US market, with those massive tariffs potentially adding 150% or more to the cost of its core LFP battery components? How quickly and effectively can Tesla shift its supply chain or ramp up domestic production to mitigate this? This feels like the biggest near-term question mark. Third, there's the perennial Tesla question: balancing future bets versus current reality. How much weight should investors give to the ambitious timelines for full self-driving, Robotaxi, and Optimus? Does the potential long-term payoff justify the current high R&D spend and the market's apparent willingness to look past weak quarterly results. Fourth, geopolitical risk is clearly front and center. Despite Tesla's significant efforts to localize production, how vulnerable is its complex global model to escalating trade tensions, particularly between the US and China? Can localization truly insulate them from major cost impacts or supply disruptions? Fifth, the brand. How much is the controversy surrounding Elon Musk's external activities, including this DOGE project, actually impacting sales and perception? Will his commitment to reduce time on DOGE be enough to reassure customers and investors? It's a factor that's hard to quantify, but impossible to ignore. And finally, it was a masterclass in narrative management. Tesla's leadership successfully pivoted the conversation away from a very weak quarter towards future potential, seemingly calming investor nerves. It raises interesting questions about what truly drives Tesla's valuation in the eyes of the market. It's a complex picture. A company navigating a self-inflicted operational speed bump, nurturing a booming energy business now facing significant external threats, betting heavily on transformative technologies, and managing brand perception issues tied to its CEO, all under intense investor scrutiny and a volatile geopolitical landscape. Q1 was messy, as predicted, but the road ahead for Tesla looks anything but boring. Well, that's all the time we have for this week's episode of Janice Talks. Thanks for tuning in, and if you like the show, please consider liking and subscribing to my channel. I am new to YouTube and learning new things every day. If you have any suggestions or comments, please leave them in the comment section below this video, and I'll be sure to review them. Join me again next week for another deep dive into the financials making headlines. I'm Janice.